Hi everyone, welcome to Certified Business Solutions, where we discuss business-related matters and give advice to business. Today, we will talk more about bonds. Dr. Kamau.
Yes,
how are you?
Lucy, fine, thank you.
You're well?
Yes, I'm well.
So what do you have for us today regarding bonds?
Yes, quite a lot.
Yes.
The other time we discussed, we defined what a bond is.
Yes.
And we say a bond is a fixed income security.
Mm-hmm.
And what we mean by fixed income security
Yes.
is that when you invest in a bond,
Mm-hmm.
at the point you are doing that investment, you
Yes.
are told
Yeah.
if it is a bond of 5 years, 10 years, or even 30 years,
Mm-hmm.
you are promised a certain rate of return,
Yes.
which is called a coupon rate.
Coupon rate. Okay.
Yes. Usually bonds are issued at a coupon rate of 10%
Yes.
per annum.
Per annum. Mhm.
And you are told every year
Yes.
will be giving you a rate of return,
Yes.
which you can refer to as interest,
Mhm.
of 10% of the value of your investment.
Yes.
If you have invested 100,000,
Yes.
what you will be receiving at the end of every year is 10% of 100,000,
Yes.
which is 10,000.
Yes.
So what that coupon rate does not change
It does not change for the entire period.
for the entire period, even if the bond even if you stay with that bond for 30 years or even 50 years.
Okay.
Now, the face value of
Yes.
the bond does not change. The face value is the
The
amount
amount that you invested.
you invested. Usually bonds are issued at a face value of 100,000.
Yes.
So 1 unit of a bond is 100,000. So
Okay.
if you buy 2 units, it's 200,000. Like that.
Okay.
So the face value
Yes.
will not change for the entire period of that bond.
Yeah.
So
The face value,
the face
does
value will not
pay,
change.
and
The coupon rate will not change. So what will change?
Yes.
The price of the bond is likely to change. Because remember,
Yeah.
once you purchase this bond
Yes.
as the original buyer, and we said bonds are very liquid. If you want to sell them,
Yes.
you don't have to wait for the bond to mature
yeah.
for the entire period of investment
Yes.
for you to be able to cash back your money.
Yes.
If you buy a bond of 25 years today,
Yes.
and tomorrow you feel you have a pressing need,
You want to sell.
you can place it on sale, and then you are likely to get a buyer.
Okay.
So, and now when you are selling it,
Yes.
it does not necessarily fetch the price that you bought it at. If you bought 1 unit at 100,000, maybe today you'll find the bond is trading at a higher price or at a lower price.
Okay.
So now the question that we need to discuss
Yes.
is what causes the price of a bond to change.
Change. Okay.
Number one,
Yes.
and that's where I want us to dwell on today,
Yes.
is inflation.
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 Okay.
Because when you purchase a bond and you are told that the rate of return is 10% for that bond per annum,
Yes.
what the company that is issuing that bond has considered
Yes.
is the rate of inflation
Yes.
at that particular moment.
Okay.
So for instance, maybe the rate of inflation is at 7%.
Yes.
The person issuing the bond, in this case, if it is a treasury bond, the government
Yes.
realizes that if the inflation rate is at 7%, then to attract people and investors to invest in this particular bond,
Yes.
then the rate of return for this bond must be higher, better than
7%.
than 7%.
Yes, yes,
So
yes.
that's why they put it at 10%.
Okay.
Maybe they say 7 plus a margin of 3%.
Yes.
They say it is now 10%.
Okay.
Now, what would happen maybe 2 years later?
Yes.
The rate of inflation has changed
Yes.
from 7% to 9%.
Yes, it has gone up.
It has gone up. And if the government wants to issue another bond
For that particular time.
for that particular time,
Yes.
now it can't issue a second bond at a rate of 10% because a difference of 1% between the inflation rate and the rate of return
Yeah.
is not a good incentive
Yeah. To attract investors.
to attract investors.
Yes.
So the government again might say it is 9% plus 3% to put a margin of 3%.
Okay.
Inflation rate, you have said it has moved from 7% to 9%.
Yeah.
Now for the government to attract investors
Yes.
to invest in this new issue of bond,
Yes.
they will say 9% plus maybe a margin of 3%. They will issue at
12%.
12%.
Yes, yes.
Again, it's a bond of it's a bond having a face value of 100,000,
100,000, yeah.
just like the other one that was issued, let's say 2 years ago,
10%, yes.
at 10%.
Yes, yes.
And if the two bonds, the term to maturity is 20 years,
Yes.
the first bond, by this time the second bond is being issued, it has already lapsed. It has already been in the market for 2 years.
Yes.
So the remaining term to maturity is 20 minus 2.
Which is 18
years.
Yeah.
Now, the government is issuing another bond at a higher rate of interest,
Yes, yes, yes.
a higher rate of return,
return.
or a higher rate of coupon rate,
Yes, yes.
12%.
Yeah.
So what would happen? People who had invested in the first bond, let's
Yes.
refer to it as A,
Yes.
would be willing to sell it off
Yes.
because so that they buy bond B, which is now being issued at a higher rate of return at 12%.
Okay. Yes, yes.
That's okay.
It is okay because the face value does not change.
The face value does not change.
Yeah.
But now what has changed is the rate of return that the government is issuing for the second,
Influenced by the
inflation rate.
Inflation.
But the specifics of bond A are not changing.
Yes, yes, yes.
The coupon rate is the same, the interest rate for that bond is the same,
Uh-huh.
and the face value is the same,
Yes, yes, yes.
and the term to maturity
It is still
the same.
Yeah.
It's only that the government now has issued another bond
Yes.
with a different set of characteristics.
Yes, yes, yes.
And the main difference is the coupon rate.
Yes.
Now government has issued at 12%. So people will decide, the investors, rational investors, because not all investors are rational.
Yeah.
So any rational investor
Yes.
will run very quickly
Yes.
to sell the first bond that he had invested heavily in, so that he can get money to invest in the second bond,
The new one.
which
Yes.
is offering a better rate of return.
Yes, yes, yes.
So what happens? He might think he's the only rational person, but when he gives an order to sell
Yes, yes,
his
yes.
bonds,
Yeah.
then maybe he gets himself being accompanied by many other rational investors
yes.
who also want to offload that
Offloaded
investment.
by the current bond.
Yes,
Yeah.
and that's where the law of demand and supply comes in.
Okay.
That whenever the supply of a commodity increases,
Yes, yes.
what happens to the price of that commodity? Whenever the supply increases,
The price will go down
The
because
price
there's surplus in the market.
the surplus in the market.
Yes.
So the price of this bond that was whose face value is 100,000 that can go down to 90,000,
Yes.
to 80,000, or even to 70,000.
Oh, okay.
So assuming
Yes.
that it has gone down to, for the sake of this discussion,
Yes.
it has gone down to about 70,000.
Yes.
You have the opportunity to buy.
Yes.
Now it is you who wants to sell your bond. You had bought it at 100,000.
Yes.
Now because you want to invest, you want to cash back your money.
Yeah.
And invest in another bond. Now you have decided to sell it at 70,000 because now all of a sudden many people are selling, and the buyer who is willing to buy your bonds
Yes.
is not willing to buy at 80,000.
Yes.
Because there is another person who is willing to sell it at 70.
70.
So you have sold it at 70. You have gone a loss of 30,000.
30,000.
But let's now, it is a choice that you have made.
Yes.
Let's discuss more about me
Who
who have bought,
from
yes,
me.
who have procured that
Yes,
bond
yes.
at 70,000.
Yeah.
What will be my rate of return per year? Remember, I will still continue to receive dividends or interest that you are entitled to as the original owner, and your interest were 10% of 100,000,
Yes.
which is 10,000.
Yes.
So to find out the rate of return for my case will be 10,000, the profit, the interest that
The
I'm
interest
getting,
rate, yeah.
divided by the cost of my investment, which is now 70,000,
70,000.
multiplied by 100, which is coming to about 14%.
14%. 14%.
Yeah, 14%. So 14% is the rate of return for my investment. So even if I have bought this investment in the second year,
Yes.
and I hold to it until maturity,
Yes.
18 years later, I will continue to get a rate of interest and to enjoy a rate of interest of 14%.
14%.
But the people who had bought the same bond when it was just issued 2 years ago,
Yes.
they will continue to get a rate of return of 10%.
10%.
So what's the difference? The difference is where you enter the system.
Okay.
Them, they enter the system when the price of the price of the bond was very high.
Yeah.
The price and the face value were equal. But with time, the price either falls or goes down,
yeah.
though the face value remains
Does not change.
Does not change.
The amount that you invested
Does
the
not
first time does not change.
Does not change.
Which is the face value.
Which is the face value.
Okay.
The face value does not change, but now the price changes.
Yes.
So the main reason for this discussion is to enlighten our viewers.
Yes.
There's a program that comes in Noro TV
Yes.
that says Irio Togetheri, which means that most of us who
Yes.
are brought up in the village,
Yes.
our mothers would cook getheri every now and then. After when we are coming back from school,
Yes.
you'll find your mother has placed a pot of getheri and she's using firewood
Yes.
to cook it. So after 3 days,
Yeah.
she would cook enough to last for 3 days.
Yeah.
So after the third day, you think now you'll change to another type of food,
Then
only to be very surprised. You get your mother now doing the same thing.
The same thing.
So it's like we are brought up knowing that the only food there is in the
Yes,
world
it's
is
githeri,
githeri.
yeah.
So there are some people who think that the only form and options of investments are shares and maybe just buying bonds at the point that they are being issued by the organization that is issuing the bonds.
Yes.
But they don't understand. You may not want to participate at the original issue, but you would want to be a second buyer.
Be a second buyer.
Yeah, so that when the circumstances have changed, you acquire the same bond at a better rate, at a better price.
I think when we had the other discussion
Yes.
about real estate,
Yes.
you see there are distressed properties.
Yes.
So
yes,
now
yes.
this one, is it a distressed
It is
bond?
it is a distressed property because
Bond,
it's a distressed bond
Yes,
investment.
Because
The word distress is something. It's more about something that is suffering pressure, depression,
Yes,
stress, and this bond is under so much pressure and it's suffering actually depression.
Yes.
Because there is another bond that is more attractive
It's
than it.
trading higher than whatever you have.
Yes.
Yeah.
And I don't know whether you, as a lady,
Yes.
women,
Yes.
you suffer that kind of stress that you are working in an organization.
Yes.
Then you were the most attractive. Then all of a sudden there's a young girl in the
Let us
office.
not continue
Yes.
that discussion.
Yes. So this bond is suffering that kind of a stress
Yes.
because there's another bond that is more attractive.
Yes.
It's a distressed
Yeah.
bond.
Yeah. So it happens.
It happens.
Yeah.
It happens. So all of a sudden, it has lost its value.
It's value, yes.
And it happens. There are other commodities that behave like that. I understand if you go to a showroom
Yes.
and you buy a Mercedes-Benz in a showroom,
Yes.
the moment you drive off that showroom, the value of that Mercedes-Benz, if you were to sell it right away, it would have lost about 20%.
20% why?
20% because it has lost that prestige.
Yes.
Not the person who will
So it
buy
was prestigious the moment it was in the showroom.
Yes.
But the moment it gets out.
a second later.
Yes.
And you know that the prestige also falls because
Yeah.
now the person who will possess it will now be referred as a second owner. Even the logbook will be showing this is not the first owner. And that by that itself,
Yes.
it makes that price,
Yes.
that commodity to lose value. But that actually it is the price that has changed. But
Not
has
the
the value
value.
changed?
No.
The value has not changed.
It is the price.
It is the price. It is the price that has changed. So that's the same thing.
Okay.
So we would want to advise our viewers
Yes.
that the timing of investment matters a lot. There are two things that are very relevant in any investment:
Yes.
time and timing.
Time and timing.
Yes, time and timing.
Elaborate.
Yes, time and timing.
Yes.
That when you make an investment, for you to benefit more from that investment, you need to hold on to it. Like now, the way we are saying, you purchase a bond of 10 of a bond whose term to maturity is 10 years.
Yes.
So if you hold on to that bond for the term of the 10 years, you are likely to benefit more. Because you have hold on to it. Or for instance, let me maybe use shares. You remember that at the time we were discussing about the shares of Safaricom. You buy the shares of Safaricom today at 5 shillings per unit,
Yes.
per share. But after 10 years, that same share will be going for 50 shillings.
Yeah. Oh, yeah. So of course, if you hold on to it.
Yes, it
of
is
course,
growing.
Yeah.
There's that there's that value appreciation, capital
Yes.
appreciation. So time is essence.
Time. Okay.
But there are people who don't respect time when it comes to investment. They buy those shares today, then tomorrow they want to offload them. They never settle. And there's a proverb in English that says, a rolling stone
I don't know.
gathers no moss.
Eh?
A rolling stone
Yes.
gathers no moss.
A rolling stone gathers no moss.
Yes.
Okay.
Moss was some kind of a plant that was very valuable. It had a lot of price.
Okay.
And you see, when and I know you have seen it, when a stone in the forest, when a stone is very static and it has stayed there for many years, there are some plants that grows. There are some plants that grow
Yeah.
on it.
Yes.
So there is that variety of a plant called moss,
Okay.
which is very very valuable.
Okay.
It is used to produce a medicine. It
Okay.
has some other uses.
Yes.
Now, for moss to grow on it, that stone has to be
This is static.
static to remain there.
Yeah.
But now we said a rolling stone gathers no moss.
Oh yeah. Of course, that is true.
Yeah. So even an investor who keeps moving from one investment to the other,
the other.
without giving it time
Yeah.
to,
There is no benefit.
there are no benefits.
Yeah.
And there's a story of a person who wanted to get firewood, and he went to the forest with an axe.
Yes.
So he would hit a few. He would hit one tree with the axe a number of times, maybe twice. Then he moves from that tree to another one, then to another one. So at the end of the day, he didn't fell any tree.
Okay.
What if he just decided to stick on one tree?
Because the tree would have fallen.
Yes, he would have fallen, and he would have gone home with
Firewood.
yes.
So he went. The person went home without firewood.
Yes. So two elements into about investment:
Yes.
timing and time.
And time.
Time we have explained.
Yes.
What about timing? Now, timing is what we had just explained about. At what point do you join the system?
Yes. Okay.
Do you want to join the system when the bonds have just been introduced, or do you want to join the system when the bonds have stayed for 1 year, for 2 years, and now you buy them as a second buyer?
Okay. For the case that you have just told us,
Yes.
I would rather go for the second buyer.
Yes. So timing is of essence.
It is of essence.
Timing is of essence.
Yes.
And timing is everything.
Yes.
But again, time is also important.
Okay.
And that's why timing, you want to check the economic condition of the country.
Yes.
You want to political condition.
Yes.
You want to check about the inflation,
Yes.
where the trends are going. So that's about timing.
Okay.
And now once you have made that decision,
Yes.
then time comes into play.
Okay. That's okay.
Yes. Actually, Warren Buffett is considered one of the richest investors in the world, not because he's very brilliant in terms of making investments.
Yes.
But it's because he started making investments when he was 11 years old.
Okay.
And now he's approaching 90.
Wow.
90 years.
Yes.
So for about 8 years,
8 years, yeah.
he has been
Investing.
Okay. So time. And also he has been very consistent in terms of the shares that he buys.
Yes.
So again, the timing.
The timing.
That's what has worked for him.
By the way, we've talked about when the interest rate goes up.
Yes.
You have not told us when it goes down.
Yes, the interest rate.
Yes.
Now the inflation.
The inflation.
Interest rate and inflation, actually, they are like twins.
Oh,
They are
okay.
like twins. Whenever inflation goes up,
Yes.
even interest rate goes up.
So inflation determines interest rate.
Yes,
Okay.
because inflation is the persistent rise of
Goods and commodities.
persistent increase in price of goods and commodities.
Yes.
So whenever the inflation is high, the government also raises the interest rates
Yes.
in order to reduce the amount of money supply circulating in the economy.
Yes.
That's why they're like twins.
Okay.
So what we have discussed is when the interest rate, when the
When the
inflation
inflation
goes
goes up.
when the inflation goes up,
Yes.
and that's why we have seen the price of this bond has also gone down.
Yeah.
Okay.
Yes.
So what would happen if inflation goes down?
Yes. Yes.
We started when inflation was at about 7%.
It went to 9%.
It went to 9%.
Yes.
Let's see, maybe in 2026,
Yes.
the inflation goes down to 5%.
Yes.
2026.
Yes.
This bond, the one that was issued in 2022,
Yes.
and we said it is a 10-year bond,
Yes.
even 2026, even in 2026, that bond will still be active.
Yes, it will still be active.
Because it will mature. If it was issued in 2022, it will mature in 2032
For 10 years.
for 10 years.
Wow.
2032. So in 2026,
Yes.
now the government issues another bond.
Yes.
And because the rate of inflation is 5%,
5%. Yeah.
and the government would want to just give a profit margin of 3%,
Yes.
the coupon rate or the rate of return of that bond that will be issued in 2026
Yes.
will be 5%, the rate of inflation by that time,
Yes.
plus maybe 3%. So it will be issued at a coupon rate of 8%.
Yes.
Okay?
Yes.
So what will happen, investors at that time, as much as the bond that will be issued by the government at that time will be given 8% and will be compensating them for the inflation at that time,
Yes.
investors will also be aware that there is a bond that was issued in 2022 and is giving a rate of return of 10%.
Or the one for 12%.
Or the one for 12%.
Yes.
But let's stick to the one,
the first one.
the first one,
Yes. 10%.
10%.
Yes.
So what will happen is that most investors, they will not be so much attracted by this bond that the government will have issued in 2026,
Yes.
which is giving a rate of return of 8%, even though it will have compensated them for the rate of inflation by then,
Yes.
because they will be aware there was another bond that is still existing, though it was issued in 2022,
Yes.
giving a rate of 10% as a rate of return.
Yes.
So people will want to buy that particular bond.
Okay.
And now the supply, the demand of that bond will increase because every other person wants to buy that bond,
Okay.
though the supply will not change because the government will not go back to 2022 to issue another bond.
Yes.
Or to increase the quantity of that bond. So the supply is very limited, but now every other person
Wants to buy that one.
wants to buy that
And those
bond.
with that bond.
Yes, they are not willing
Majority
to buy.
they don't want to sell.
They don't want to sell. They don't want to
So
sell.
for that person who want to sell,
For that person who wants to sell,
yeah.
no, they will want to sell.
They,
Yeah.
they will want to sell. I thought
Everything is usually on sale.
Yes.
Even your car. You might think you love your car so much.
Yeah.
If you bought it at 1 million and you love it so much,
Yes.
and someone comes and tells you, I can buy this car at 1.5 million. Will you still say, I love my car so much?
I will sell it and buy another one.
Yes. So the one who bought the bonds at 100,000
Yes.
in 2022, now if they are offered 110,000 for that bond, they will sell.
They will sell.
They will sell. So any person who is willing to buy that bond that was issued in 2022 will get an opportunity, but will do so at a higher price than the original price.
Okay.
So whenever the interest rates or the inflation goes down,
Yes.
the price of the bond goes up.
Goes up. Okay.
Goes up.
So if the other one you have seen that we were buying it at 70,000
70,000.
when the inflation went up.
Yes, when the inflation went up.
But now
Yes.
the inflation has gone down.
Yes.
So they'll buy at a price more than 100.
Yes, at a price more than 100.
Yes.
So what will happen? You have bought it at a price more than 100. Let's say you have bought it at 110,000.
Okay.
110,000.
Yes.
But remember, the rate of interest that you will continue to receive on this bond is based on the initial price that was 100,000.
Yes, yes.
And it is still referred as the face value of that bond.
Yes.
So the rate of return or the yield that you'll be getting as an investor
Yes.
will be, we say it is 10,000 because
Yes.
it is 10% of the original value, which is 100,000.
Yes.
10% of 100,000 is 10,000.
10,000, yes.
So we'll say it is 10,000 divided by 110,000 because that's the amount that
The
you
amount
have
that
used.
you have bought.
Yes, it's that particular bond
Takes 100.
times 100. So we are saying 110 divided by 10,000 divided by 110 times 100.
Okay.
It will come maybe to about 8% or thereabout.
8%.
8%. It will come to about 8%.
Okay.
And which is still okay.
Yes.
Because remember, actually it is the same with the rate of the rate of return of the bond that has just been issued by the government. Because remember, we said we are now in 2026. The rate of inflation is at 5%, and the government has decided to issue another bond. And based on the rate of inflation 5%,
Yes.
it adds a margin of about 3%
Yes.
to make it 8%. So the rate of return for this bond is 8%.
Okay.
The bond that is has just been issued assuming now we are in 2026.
Yes.
Now we had gone back to the bond that was issued in 2022.
Yes.
And someone has decided to buy it at a higher price than the way it was issued.
Yes.
110,000.
Yeah.
But this person, even if you have bought this bond at a higher price, the interest that you will continue to receive per year is 10,000.
But the other one you will get 8%.
So we have said it is 10,000 divided by 110,000.
Yes.
So that we get the rate of
The rate
return
of
for that
return.
person.
Yes.
So it is coming to 8%.
Okay.
So if you go to the original bond that was
Yes.
issued in 2022,
Yes.
thinking that you will benefit a better rate of return, you will not do that because you will buy it at a higher price.
At a higher price.
Actually, at the end of the day,
Yes.
the rate of return for that bond, if you go back and buy it at a higher price, the rate of return is 8%. We have seen it. And the rate of return that is being offered by the government, assuming we are now in 2026,
Yes.
it is also 8%.
Oh, so there's no difference.
There's no difference.
Oh.
But sometimes you might get a difference. This is just a hypothetical
Okay.
example.
Okay. You might get a small difference.
Yes, a small difference.
Okay.
So the bottom line is,
Yes.
the bottom line, prices of bond don't stay the same.
Okay.
They change. What remains the same is the face value of the bond and also the coupon rate
yes.
of that particular bond
Yes.
and the term to maturity. If it was a bond issued to stay for 5 years, 10 years, 30 years, that will remain the same.
Okay.
So how does the price of a bond change? Whenever the interest rate
Yes.
rises or inflation rises,
Yes.
we have seen the price of a bond behaves in an inverse manner because they are inversely related.
Yes. Yes.
So the interest rate is going up,
Yeah.
the price of the bond
Goes down.
goes down. The interest rate is going down, and the inflation is going down. The price of the bond
Goes up.
goes up.
Okay.
That's what we wanted to inform our viewers today,
Yes.
for them to know that as that program that comes in Inoro,
Yeah.
that says Irioto Githeri,
Yes.
meaning food is not only Githeri,
Yeah.
not only the traditional ones. Because if you continue investing using traditional methods,
Yes.
you will continue getting traditional rate of return.
Yeah.
So the sooner a person is able to employ other strategies and tactics
Yes. Yes.
when it comes to investing, the sooner that person will start getting better rate of returns.
I think
And-
in simple terms,
Yes,
that is why we are here.
that's why we are here.
But
No.
I have another question.
Yes.
So how can an investor
Yes,
prevent bonds, the rate of return from being affected?
yes, okay. That's a very good question. It's nothing is guaranteed.
Yes.
Nothing is guaranteed. So when you invest in bonds, unless you insure it, so that you say that if the price change, if price changes contrary to what I had anticipated, then insurance will come in and compensate me.
Yes.
Just like you would insure your car and say, in the event that I'm hit by a lorry, and God forbid, then insurance would be able to compensate me for that. But there's a specific solution to the bond holders, those people who buy bonds. There's a type of a bond that is called or known as inflation-linked bond. Inflation-linked bond. This is a bond that most bonds are created in a way that the coupon rate does not change. You remember that's what we had said. The rate of interest attached to that particular bond does not change. But there's a category of bonds whose interest rate changes depending on the change in the inflation. So, for instance, you remember we started at 7%.
Yes.
And the bond was being issued at a rate of 10% coupon rate. So, when the inflation went from 7% to 9%, it increased by 2% inflation. So, there's a variety of bond that allows even the coupon rate or the interest rate attached to that bond to also change to mimic or to match the change in the rate of change of inflation. So for this case, in this case, when the inflation moved from 7% to 9%, the rate of return for this bond would have moved from 10% to 12%. So in that case, the value or the purchasing power of the money that this investor will continue to receive over the term of that bond will not be affected by inflation, because whenever inflation increases, the investor is compensated for that increase in inflation.
Okay. I think that's okay. That is nice. Viewers, we hope that you have gotten something from what we have discussed. Stay tuned for more tips on investing and business advices. Don't forget to subscribe, to share, and to leave comment on the videos that we always share. See you next time.
Thank you.